Good afternoon, everyone, and welcome to the second episode of FinNext. Welcome to ETBFSI.com by the Economic Times and this special series of FinNext we have been doing specifically to cover the fintechs diligently or unleash the different layers that the fintechs are going through right now. Uh, the challenge today, or maybe the major development that is happening in the fintech space today, is there are regulations, there are innovations, but more importantly, there is a slight funding winter, and every fintech is kind of asking how long this funding winter will continue, whether it is sustainable, when the investors will actually speed up the funding process. So these are the main questions, and that's where we thought that we'll discuss this with the veterans in the industry. And today is our second episode, specifically talking about what next in the fintechs. Since ETBFSI cover this segment diligently, we have been covering this fintech episode, and we are also going to have a special event on the FinNext very soon, maybe in June in Bangalore. And there also we will cover what next for fintechs far more aggressively. But friends, let me tell you that today we have the best speakers from the industry. Few of them are actually running the fintechs, and few of them are actually the influencers and running the ecosystem, and very famous in the ecosystem. So let me introduce them to all of you first, and we'll begin the show. So my first speaker for this particular session is Mr. Mohit Jain, CEO of Freecharge. Mohit, glad to have you. My next speaker is Mr. Samir Singh Jaini, CEO and co-founder Digital Fifth. Samir, glad to have you.
Or to learning from you, each one of
My
you.
next speaker is Dhruv Jain, CEO Kashi. Dhruv, glad to have you. My next speaker is Mr. Alok Mittal, co-founder and CEO Indify Technologies. Alok, glad to have you.
Thank you, Amol. Glad to be here.
And my last speaker for this panel discussion is Mr. Abhinav Suri, co-founder Stride One. Abhinav, glad to have you.
Thank you. Good afternoon.
Thank you, gentlemen, and let's begin. I would also request all the friends who are watching this show on any platform, whether it's LinkedIn, Facebook, or Twitter. If you have any questions specifically related to the theme, which is FinNext, do share your question in a chat window of any social media platform you're watching through, or maybe on ATBFSI portal itself, and we'll try my best to take that question with the speakers that we have. So Samir, Mohit, Abhinav, Alok, and Dhruv, my first and common question to all of you is, what's happening with the fintechs right now? What is the current state or funding? What are investors looking at before investing? How do you read out the current situation? And Alok, I will start with you.
Amol, investors have become more discerning over the last 9 months or so. There is an emphasis on quality of the business. In generalistic parlance, that is coming across as focus on profitability. But really, when an investor looks at a business, they're looking at everything from scalability to what moats the business is building around itself, the quality of management teams. And certainly in this environment, there is a bias towards backing profitable companies rather than ones that might still be burning cash. Having said that, we are seeing transactions progress. So in my mind, this is not a chilly winter. This is clearly, springtime. As much as we would like, more flowers and more green shoots, the weather certainly seems pleasant and not chilly.
Oh, quite interesting. Though the climate is changing, you're seeing that the winter is not there in the fintech space. Quite interesting, Alok. Let me come to Mohit and understand from you, Mohit.
Yeah, so hi, Amol. So the way I see it is, I think over last few years, maybe 10, 15 years, the industry has evolved a lot. I think today, at least 90% of business models in fintechs are reasonably clear to investors. So people who are doing well, there is far more clarity in terms of who are on the right path. So I don't think there is any funding winter for folks who are delivering outcomes, who are reasonably there. Naturally, sort of seed stage funding, etc., may not be at the same pace. So that's one thing. Second, I think the other side of funding winter, which is less talked about, specifically on the lending fintech side, is liquidity or debt capital. With regulatory interventions, that's becoming more and more sort of easier. There are things which keep on coming. So I think sort of the things are geared up for sort of better times. Maybe some replication of international events, but largely, I think funding winter is a sort of imported term, not fully sort of there for the fintechs in India at this point of time, I feel. But clearly, at the seed stage, maybe slight
Right.
slowness.
Okay, so seed stage you see some pickup, but and not a full funding winter there. Noted your points, Mohit. Samir, how do you see the situation now? What is your opening remarks?
So maybe I'll try to split into pieces. I'll not take from investor view, but a generic business view. Uh, Earlier, I think the ideas were getting funded with a lot of excitement. I don't know where's the excitement on fintech business. It's a very grueling business, right? You like day in and day out. I think we had this thing on neo banking. Everybody was getting funded, and everybody wanted to become a neo bank. So I think it's get fashionable at times, and then the guys who come later get funded, overfunded, and there's not enough business, right? I mean, technically, the slice of life when you're looking at a payment, that the slice of money is very small.
Hmm.
When you look at lending, the slice of money is very small unless you have access to a large amount of pool of customers,
Hmm.
which you may happen if you are in embedded finance. But if you are, the primary job is to get customer access, it is time consuming. So my personal sense is that there was a fair amount of wastage of money happening, which technically would have created a lot of holes, which will take time to get filled up, right? I mean, you think of a bank which makes losses in, maybe I know I worked in a bank which made losses in 2008-9. To come out of them, it took them 6 to 7 years, right? It does take time to come out. So I think the point is that in financial services, the money which is to be made is limited. You can lose the money by overpaying people. So there's a lot of overpayment to people or technology and all of that. I know that on cloud, people are burning capital for random sense, right? I don't know. But let's look at it. What has happened is that it's brought more focused on the founder side. I met a founder yesterday. He's saying, I started operating finally on a P&L basis, right? After 6 years of business, because he did not know what I was doing. I have to scale because I have to scale, right? Investors are after my blood to scale up. So I think one side, there's more sense to it, and it'll ensure that the money is conserved for right purposes. Financial services grueling, tough, long term. Money. I mean, you have to do renewals. Credit card works only when you run it for many years. So that's one side. Companies will get funded who are on the right side. There's of course the regulatory arbitrage is gone, so it does take an impact on those who are just coming back with a frivolous idea and then still getting funded. So good guys are getting funded now, but it's a slow journey. It will take some time to recover because psychologically, har aadmi bolta hai, there's a serious issue on the funding side. So people assume that it's funding issue, and then even those investors who want to invest are scared that am I getting into the wrong time, right? So it's the same stock market issue. When everything is hot, everybody want to burn cash, right? When it is low, nobody want to burn cash. The
Right.
third point is that innovation is over a time when everybody getting funded, innovation loses focus, right? I think the innovation is coming back. It will take the next level of thinking because the primary issue is solved, right? Our retail may credit has happened, BNPL has happened and gone and come back in new avatar. You have MSME started. Now I think my sense is that a lot of innovation has happened on a particular segment. It will happen also, for example, on B2B side. B2B side problems are really unsolved. Not too many guys have solved for it. So that's another space to solve. So I'll pause now. But I think my sense is you need to pause before you start a
Right.
new journey. New journey is started. I'm finding much more smarter founders to come up with newer ideas.
Okay, sure. So I will come back to all of you. And in fact, when we say that right companies are getting funded, I would all of you, in fact, give some thoughts on who are those right companies and what are those investors looking for. But thanks for adding that point, Samir. I think picking up one small point from your talk is, fair amount of wastage, wastage of money, is stopped happening now. So I think let's understand that the startups and the founders will not buy Audis and BMWs anymore, perhaps. So if that's this wastage of money which happened earlier. Let me come to you, Dhruv, and learn from you in terms of what is the state of fintechs that you see right now.
Yeah, Amol, thanks. Pretty interesting discussion till now, and a lot of points which we discussed. I'll have to break it up into kind of two parts.
Mhm.
Is there a winter? Possibly yes, but what is it that is happening? People are looking at quality. That's the way I look at it. And if I look at it as debt capital and equity capital, I think on the equity capital front, there are some bit of headwinds which are there where people are very selective as to where they want to fund and what sort of business matrices they want to look at. On the debt side, I think since we are an NBFC, on the debt side, we don't see that much amount of winter because there is liquidity available and money is there for right businesses, right opportunities. I think where investors are making a difference is the fact that they are now analyzing companies on the basis of their profitability, on the basis of their track record, on the basis of how their management team is, what is a bandwidth, what is a product innovation, and what kind of of how are you geared up for your regulatory framework perspective, because that again I believe is something which has come up and is becoming a very strong feature now. Obviously, one needs to keep. Obviously, these investors also look at what are the kind of cost structures you have, what are the credit costs you have. So, all in all, I think the differentiation is there from from a mind of an investor as to whether he wants to invest in a company which is kind of having a roadmap to profitability or otherwise. So, to me, it seems more like a situation that it's company dependent, company specific rather than industry as such. Having said that, definitely 2022 was lower than 2021, but higher than maybe 2020. So as we move forward, and maybe if we see some amount of internationally rates kind of stabilizing, maybe in the US if rates are stabilized or they at some point of time they get cut, then you will see that much more liquidity coming in even on the capital side. That's broadly how I would like to put it up.
Sure. Meaningful thoughts through. Abhinav?
Yeah, I guess a lot of points have been made, and I agree with most of them. And if you define funding winter as something where good companies, good business models are not getting funded, then yes, funding winter is not there. But if you define funding winter by saying that is it taking longer for you to raise capital? Yes, it's taking longer because there's less FOMO. Because liquidity is less, which means that investors are asking the right questions and they're taking time before they take decisions. So it's not that all these questions were not there in their minds. It's just that before that, they didn't have the time because of so much liquidity pumping in when decisions were made, which may not have money wasted and things like that, and business models which do not have core unit economics strength were funded. If you look at it from a quarter-on-quarter basis, you are seeing green shoots appearing. Overall funding also, if you see the reduction, it's reduced significantly. And in fintech specifically, I think there's been a growth if you see quarter-on-quarter. So by that, I agree with Alok that springtime is here. It's not right to compare year-on-year because last year Q1 was the peak summer, as they say. So it's not just the right, yeah. So yeah, that's broadly my view.
Sure. Noted your points, and I would also ask the readers, viewers, if you have any questions, please go ahead and shoot your questions. So, gentlemen, let me get into some specific questions now. And if we look at the data, obviously we are not even looking at the quarter-to-quarter data, but if you look at specifically YOY, 3 years back we raised 12 billion. After that we raised 42 billion. After that we raised 25 billion. So there is a mismatch in terms of the whole funding that we have raised. Obviously there was a rally earlier, and now if investors are going slow, that could be a different situation, maybe international references and geopolitical tensions and so many. But my now specific question to Alok, you is, how do you see the whole profitability model? Do you think that fintechs can actually look at profitability maybe a year or two down the line? Because like Samir said, the losses which his bank made in 2008-9, it took 6 to 7 years for them to, come up with, right? So making after burning enough cash, after perhaps building a product which is not profitable, do you think maybe fintechs will have an easy journey towards profitability, Alok?
Yeah, well, I think there is sufficient room for maturing on the profitability curve, right? And profitability is not one milestone that happens suddenly. So I think what Samir was talking about was accumulated profitability.
Yes.
Before that, you will get to current operational profitability. Before that, you will get to unit margin profitability, right? And even before that, you will get to some sort of a PMF that demonstrates customers' ability to pay. Now, all these constitute the journey towards profitability. investors at coming in at different stages of a company will appreciate these different levels of thresholds at which that company might be operating. So if there's a lending business which is, few thousand crores and not making money on a consolidated basis, I think that is a problem. If there's a lending business, at a couple of 100 crores which is not making unit margin, I think there is a problem. Right. And if there is a lending business that is operating at 20 crores, have they proven the segment, the market they're going after, some differentiation in their approach to handle that market? Given that in lending business, customers are used to paying, the revenue risk doesn't seem to be there. So, the profitability question gets calibrated by stage and size of the business. I think what seems to be hurting here are businesses which did not have a strong monetization thesis to start with. Right? So especially, as an example, we sit in the MSME industry, and there are a lot of businesses that have tried to generate engagement from small businesses with the view that they will be able to monetize it later through credit.
Right.
Now, I love that thesis, right? I think that is exactly where the world is headed. But unfortunately, in this down cycle of investments, those are the kind of businesses that are facing tougher questions regarding, is credit a natural product on top of this engagement that you're creating or not? Right? And can you show us evidence for being able to attach credit on top of it? Are you building a team and a culture which is required of a credit business? Or, is the team and culture largely geared towards a technology business and doesn't quite understand how to layer technology, how to layer credit on top of the platform? So I think that is the nature of questions and nature of businesses that are finding it more challenging than others. Samir mentioned this earlier. There are certain classes of credit that were unproven from a monetization and profitability and defensibility standpoint, right? BNPL has come under severe scrutiny across the world, right? Because in many of those cases, independent franchise was not being developed either towards the merchant or towards the consumer, right? You're sitting behind the merchant, the customer largely being unaware of your presence,
Right.
And attaching a credit product which was inherently tied to the merchant's offering,
Right.
very often under the merchant brand name and merchant's pricing. So their questions of viability, scale, and defensibility have come up. So there are some of these credit products where there is a question mark, and not just in India, but globally. And then there are certain, other kind of, largely speaking, payment and engagement utilities, where the thesis to monetization was parked in favor of achieving the initial engagement. And I think there is an expected acceleration of that journey on part of investors.
Okay, sure. Dhruv, when we speak about specifically digital lending, you're not just a registered NBFC, but you're offering variety of products. And I see a different trend now, specifically with the digital lending. Travel now, enjoy now, eat now, dinner now, and pay later, buy anything and then pay later. But many of these products are kind of a small ticket products, which obviously the banks and the large NBFCs could not, disburse, or maybe could not even process these products. And because of fintechs, they are doing that. But by launching these products, you are maybe catering to the Gen Zs and millennials who are aspiring for these products. But is it actually helping maybe a NBFC like you or a fintechs, those who are working as an aggregator in terms of generating enough revenue, making enough profit, though it's digital ultimately, they must be burning some cash ultimately, to acquire these customers and serve them and, disburse them loans.
Yeah. No, thanks, Amal. I think the way we look at this is not just one particular loan in totality. We look at it as kind of a customer journey, and maybe the start of the journey is through a BNPL product. It could be a travel now, pay later, it could be a QR code, it could be whatever. That's the initial journey. The idea is here is that you get people into the ecosystem, you make them aware about credit, and then you kind of take them up the value chain and help them prove their capability to repay. So this is an entire journey which one has to go through. So while you're right, it's not possible that you're on a very small ticket loan, you may not get the unit matrix which you're looking at. But hey, this is a journey which involves a customer with us and it then takes forward. And over the period of time, it helps us build the value for the customer and for the company. So it's a proposition where both the parties are together. It's not just a question of maybe one loan or a one BNPL product or a one travel now pay later product. It's a question of keeping him, providing him with the money when he needs it. His repayment helps him to kind of upscale himself at some point of time and maybe go for a next loan, which could be maybe a different type of a product. So it's in totality, we try and make money in each customer, which is what we call it as unit economics profitability, which ultimately drives from a profitability point of view is a main area for us. So it's not just again, just summing it up, it's not just one loan or one small product, it's a value chain which you cannot build around it. So that's how we look at it.
Okay, sure, Dhruv. Mohit, I was going through the free charge website and I could see, you're still offering cashbacks, which I see, the cashback kind of shifted to a different loyalty points, and no one is these days, offering a cash as a reward anymore. Maybe they're giving a lot of benefits. So let me ask you very specifically, is it difficult for now, or is it now known fact that the fintech companies cannot make money in payments except the typical cross border payments that we are thinking of, and that's also one of the strong reason that everybody is getting into the credit business?
So I think so from a regulatory landscape perspective, if you look at UPI rails, if you look at RuPay card, if you look at MDRs, practically all sort of point to the same direction, that as such payments would not be a sort of profit leader product. It's more of a flywheel on which you need to sit and create lending products. So clearly, I think the larger mindset is on the profitability through lending. Even if you look at people who are outside payments, I think saving and deposits or neobank type of architecture also, the payment is not on saving on deposits. There also you will see already some segues happening on incremental. You will sort of see it coming in few days, a few months. Again, lending will be the case. So other than, let's say, cross-border payments, or let's say specific use cases like sort of point-in-time lending or sort of investing, where you are a brokerage house, those are some profit pools. But largely, it's very, very apparent that in the fintech space, if you leave out insurance as such, 80 to 90% of profit pools are now looking sort of consolidated in lending as an end use.
Okay. uh, Abhinav, I guess you deal with MSMEs and different set of customers. What kind of demand do you see there? Do you see enough demand for maybe fintechs? Because everybody is talking a lot about SMB, MSME, financing the microfinance entrepreneurs and all. So is there enough demand specifically that the fintechs are seeing, which will make them profitable going ahead?
MSME financing, I think there's a lot of demand, and I guess the credit growth numbers also supporting that. Same time, see, a lot of MSMEs are restricted from traditional capital by the collateral they can provide. So all the new revenues that they generate, they need a fintech support or a support where they can bring in say a B2B channel like a new age startup or a fintech to support their additional purchase orders. So yeah, the demand wise is fine. Way Stride One works is that we actually deal with startups, and we onboard the MSMEs through the startup ecosystem. So typically, your B2B startups or a consumer startup for their distribution channel, etc. And we are seeing that that demand is robust, not an issue.
Okay. Samir, you must be interacting with a lot of fintechs and dealing with them. I want to see how obviously international dynamic is one aspect where the foreigners are not investing as aggressively as they were. But do you see that the impact of the regulations, specifically when RBI came with guidelines on the digital lending, when they became very strong specifically and asked fintechs to follow the KYC guidelines, for PPI and other companies, do you think that is playing a major role also in investors' mind before pumping into the money into fintechs? How do you see the whole translation of regulations?
I think from the market perspective, what happened specifically in the last year, I think there were obviously places where the scars are very deep and will continue to be there for a long time. So those impacts are there. People were also not very careful about regulations over a period of time. But I think if I look at today, any of these founders, they're very, very keen on focusing on uh, uh, maybe the entire compliance on day one. And RBI keeps giving more compliance requirements all the day. I mean, we had something on outsourcing, something on this, something on that. So I think the language is getting more and more understood. I think sometime back we were talking about that tech DNA versus the financial service DNA. It's very, very specific thought process. I think Alok, you were saying it's very specific one, right? Because यार करते हैं यार, कुछ फर्क नहीं पड़ता. I think that is gone, which is good for the ecosystem, right? We were playing. I mean, even today, if I were to be brutally honest, I mean, hand on my heart, is everybody following the KYC process? Absolutely no. I think the issues are still there, but I think compliances are improving dramatically. And at least founders and the board are all looking at saying, are we compliant or not? Language has changed in the last 1 or 2 years more and more as we see. So I think it's a theme. I think many of them are hiring ex regulators on board and also they're having their advisory teams. We ourselves are working with some on the IT compliance or security compliance. So that was not earlier the case. So I think this is changing, and of course the business models are also changing, right? We know that the gray area don't even enter there. I think that is also playing on the mind. So many of them are now trying to figure out can they become a TSP, technology service provider, instead of LSP framework. So I think there's a movement, great movement towards B2B entities, because of this compliance changes. So I think B2B, more and more companies will get created. I'll have a simple one view. We think of only retail and MSME, and that also frontline, as the only segment where the improvements can be done. We've not touched the treasury system. We've not touched the corporate side. We've not even touched anything which happens on the back office side. Anything which the banks right now do, and banks are going digital as well. They are also not leaving. So there is enough and more to be done. But maybe those, as we said, the opportunities may not be a unicorn kind of opportunities. I would see hundreds of maybe 100 million kind of opportunities which may exist, which we will have to sort of solve for. But if you are excited only about unicorn kind of entities, I think those will be less, and then you need significant more innovation than what has happened till now.
Okay, so the race for unicorn is over.
No, not really, but I think innovation ऐसा ही हो सकता है कि मैं इस segment के लिए इतना बड़ा कर दूंगा. That is how it is, right? I will launch BNPL, I'll go scale, and I'll become I'll launch a neobank, and I'll launch with this fanfare, and something will happen. So I think that excitement should get over, and I seriously believe it's a slightly long-term game, right? I think it's not that easy. If it was, then all banks should be putting ads on the TV. You don't see banks active, right? Because they know it's tough to earn the money back.
Right. Yeah, but thanks for adding that. But gentlemen, when it comes to ads, there are a couple of fintech players have been, spending a lot on ads. You watch the IPL, you watch the major shows, and you will see their hoardings, right? So that's one of the interesting part that you see. On one side, you feel good because the new companies, emerging companies, are investing heavily. I have a couple of questions also from the audience. There is this one question which the gentleman called Abhishek Modi has asked. And Alok, I would like you to take this, and maybe if someone else wants to add to it, please feel free. The question is more important than the winter longevity. The key question is, have startups learned anything out of this? Would they be more attuned towards creating true customer value as opposed to valuation inflationary focus only?
Yeah, I'm careful about learning because whatever we learn in one cycle doesn't apply to the next one. And I think, startups and founders need to learn how to be agile. There is a time when capital is scarce, and a set of metrics is, what is required to then generate capital for the startup and build the company. There is a point in time where, capital is abundant, and hence the focus is not on efficiently deploying capital, but leveraging cheap capital to grow as fast as you can. Is any of those points of views incorrect? When we go through a cycle, whatever is the most recent debacle looks like the foolish thing to do. But I do think both of those have a place under the sun. And presence of these cycles actually ensures that we stay honest to the customers. But tomorrow, let us say, we start seeing another $40 billion VCP here in India. Would I advise founders to hunker down? The answer is no, right? Because there are many opportunities that come up that can be leveraged through the use of that capital. and people who can be aggressive from a capital utilization and growth standpoint in those markets can occupy the leadership slot. Now, there are some fundamentals like, are you focusing on customer value and so on and so forth. I think those are basics of a startup. And I would not suggest that even founders who have raised $500 million or $1 billion in the previous cycle were impervious to that. I think they were focused on creating value for customers. However, the pressure on unit margins wasn't that high, right? There was more premium to building a franchise and getting to a dominant share of the market. And when the market affords you an opportunity to do that, it affords you the capital to do that. Then I think many of the smart founders will, size up to that opportunity and respond to that. So what may look like the truth today is not a universal truth, as much as what looked like the truth in 2021 wasn't.
And remember, this industry is just maybe 7 to 8 years old or 10 years old. So we can't expect everything to be learned by everyone. Gala sabka सूखता है, tar sabko lagta hai, right? It's the same scenario. किसी को पता नहीं है.
Sure. Thanks for that caption, Samir. So Mohit, how is it for you? You have a great backing. Maybe a bank is there, so perhaps you don't need to, worry if even you go through a, funding crisis. But how do you see the major difference when you see your peers or maybe competitors, those who have investors and dealing with, the same pie that you are also chasing? How do you see that whole competition shaping up now?
So I think one of the things that clearly is visible, because when I talk to peers or people who are in lending partnership with bank NBFCs, is people who are burning cash. I think the mindset in terms of runway of being at least 4, 3, 5 years type of mindset has come in very, very common. So now founders are very, very conservative in terms of cash burn and the runway that they have in the financial service space. Second, I think the conversation with any lending fintech, I think it's now starting with risk and risk mitigations and collections as against my sort of sourcing engine. So the sort of mindset has massively shifted in terms of quality of franchise as against pace of franchise. I think that clearly is there. Sustainability has sort of taken roots. I think on the compliance side, I think it's largely regulatory like pushing it, and I think it's for better only rather than the worse. Maybe some small pieces on KYC etc. yet to be solved, but largely I think industry is now settling in a pace where it's fintechs, at least on the lending side, are also 90%, 95% on the space where from a diligence methodology conviction part, it's not like as Alok was saying, Samir was saying, जाते हैं करते हैं, and then we'll figure out कि let's create 100 crore of NPA, we'll learn from that, and next year we'll solve for it. People are sort of thinking very differently in terms of these things, because these not only impact your cash burn, but also the next round. Because now people are looking at it as a sort of input into the next round of equity as well as other pieces. So I think that is a meaningful change that's practically happened every month as we have progressed over last 2 years.
Okay. So I will speak to all of you on next round specifically, but let me shoot one more question to Dhruv on the digital lending part. So Dhruv, how do you see the whole the impact of regulations panning out now? Because one, the compliance cost will also go up suddenly. The regulated entities, I mean, you are again a regulated entity, but if you are dealing with the the LSPs and all, you will have to monitor them very aggressively. And again, you are working in a majority of you are in fact working in an unsecured loans, right? So perhaps due diligence has to go up significantly, underwriting has to go up significantly. So do you see a major impact there which will kind of reduce the number of disbursals, number of loans going ahead?
So Amol, the way we look at it is that it's a function of how you do your business in the regulatory framework. Yes, you're right. The kind of regulations coming in are kind of increasing day by day, and every few days, few weeks, we see some kind of a regulation coming in. But it's good for the industry on an overall basis. What it does is it sets the practice as a good governance framework is set, and that sort of ensures that you follow the norms which in turn gives a lot of satisfaction to the customer, in the sense that he's aware that data privacy is maintained, your AML, KYC details are taken care of. So we do not see any kind of a stoppage over there, but we see this as an enabler. It kind of takes away the ways of doing business to be somewhat in line with what RBI wants. Because having said that, we as an NBFC are regulated by RBI, so we have to follow the norms as laid down with the prescribed. So it's upon us, the onus is on us to kind of maintain the way regulators want to look at it. So net we see that this regulations, even if they come in, maybe they have a bit of a short-term challenge in terms of you scaling yourself up and building your internal systems to gear to that. But over a mid to a long-term period of time, I think it's beneficial for the industry as such. So clearly we see positives coming out of this.
Okay, sure. Abhinav, you raised, I think, 250 crores, perhaps the same month last year.
That's right. Yeah.
Yeah. So, are you going for next round, or are you going to just wait and watch, or you tell us also that is the fund over 250 crores, or you're still using them? How's it?
No, so that was a combination of debt and equity, and
Right.
yeah, we will be looking for raising another round maybe in a quarter or so.
Yeah.
While we've been profitable from day one, it's just the demand side. The demand is looking very good, and that means that we need to increase the capital base to keep the leverage intact, and that's the reason to raise more capital.
Sure. So you sometime back said about right questions, and the viewer. That's why I asked you, because the viewer is also asking you a specific question now. You raised large funds, so you must have been drilled by investors. And now, when you say there are right questions, should be asked, investors are asking right questions. So there are
Yeah.
these couple of people who wants to know what are the right questions that investors are asking. What are they looking for the fintechs today before investing to make sure that money isn't wasted? So you are the one who raised the fund maybe very recently. You are the right one to answer these right questions
No,
now.
I think the questions are similar to what the rest of the panelists were saying. Alok, Samir, is that unit economics, and depending on where you are in
Right.
the scheme of things, early stage, it should be very clear which customer segment you're looking for, and have you seen some product market fit in the beginning. If it's more middle stage, then have you proven the unit economics in that customer segment, and you are then maybe needing more capital for burn also, but it's good burn because you're entering new geographies or you're enhancing capabilities around the same customer segment. And so it's this good burn versus bad burn questions, and driving deeper over there. Second is the regulatory aspects, because now there's less regulatory uncertainty, and I think business models built on regulatory arbitrage are not something that investors would want. So going deeper on the compliance aspects, on the team aspect, the experience that the team brings in, and the hiring plans, and technology plans. So I guess these questions are always there. It's just that now investors are taking more time because they have more time. Because that what I was saying earlier was that there's less FOMO, right? So it's not that you have 10 investors vying for the same deal, and then they have probably each investor has maybe a few weeks to decide, and the diligence also to take place. Now, because there is more time, as investors are taking, they're pausing, these questions are coming into the fray.
Okay. Uh, Alok, there is one more important question that I want to ask, and even as a journalist, also I face that question quite often. So, when it's a regulated entity or listed entities, it's very easy for me to obtain the data of all these companies. But when it comes to fintechs, I have to rely on the founder and CEO, whatever data he tells me. Right? Even if he tells me I have maybe 3 million customers or download, I buy that story. The next month he says I have 5 million customers, I buy that story. They never disclose the uninstalled applications data, or the customers those who could not retain, or the customers maybe left them. So what could be the metrics maybe for investors also, and readers and viewers of fintechs, to follow and find out whether that fintech is doing good or bad according to you? If you have any, I know there won't be a straightforward answer, but any analogy that you want to share here?
Yeah. See, these are private companies. So to that extent, if I may, it's no one's business, right? So there is a degree of scrutiny that comes in from being a public company. There's a degree of scrutiny that comes from being a company that is managing public money, and that's the term I will use for what you're calling as regulated entity, right? That is the reason why we should disclose more, because ultimately we are using funds from that pocket. As far as investors are concerned, they will typically look at data in various different forms and shapes, right? So they will ask for the uninstalled data, and founders will share the uninstalled actives, all of data with them, because there is a investment conversation that is happening. The beautiful part about metrics is that they are extremely business dependent. Right? So you can cross check data, right? If you're just purely interested in what are the monthly actives on different applications, that data is available reasonably reliably from third party metrics. But is that the right metric for that business or not is the fundamental question. So the need to simplify and standardize this notion of what the metrics are, in my mind, actually is counter to an entrepreneur's thesis in what will build value in a company. I don't think any of the entrepreneurs today are looking at their business and saying MAUs will build value in my business, right? And hence the entrepreneur has the prerogative to tell their story. So I don't think there is a problem in here, in the sense that public at large does not have visibility into these startups. That is exactly why these are private companies. Do investors have that view? Absolutely, yes. Have there been standalone incidents where investors were blindsided? Sure, they have been, but I've been in those shoes. It is our responsibility, right? We have a fiduciary responsibility when we invest in a company, to make sure we do what we can do to truly understand what the business is about, audit if required, and that's our responsibility, in those shoes as investors. So yeah, I agree with you that there is opacity in success metrics that founders quote, especially in private companies. But I don't see what the problem there is.
No, sure. So I will do one thing now. I will have two important questions which I will shoot all of you, and very simple but very important questions. The first question is you partly answered, Abhinav, Alok, Samir. You already rejoined that, but if there is anything missing and you specifically want to add, is when we say that right companies are getting funded. This question to all of you, and Samir, I want you to start. Which are those right companies? What do you mean by right companies? What is it that the definition that the investor means for the right companies now?
Okay, let me revert. Right companies as per me as of now. Okay, who knows what's going to happen later on? We just can't define. But whatever logics we have learned in this period, I'm basing on it. So my view is simple. If you are chasing, for example, somebody came back saying, "I'm going to sort of do a B2C company in some segment," is not going to make it. The DNA of the founder is also critical. So the ability to evaluate the founder is getting much better for for the investors, for people like us, right? We meet so many people, we understand the DNA, and then we will take them the right direction if we have to. There's a B2B DNA, B2C DNA, but with the funding so much coming, B2B guys were turning B2C for random sake, right? Because paisa hai to utha lo. Let's figure out what we'll do. I've seen so many 40 plus people just talking about funding all the time. I think that discussion is over. So as I spoke about B2B segment, there's enough money to be made as such, a lot of money to be made, because you have to realize BKC has so many towers, and those towers are run for certain activities, which we must be very very expensive. That's why it runs out to that place. So can we automate, simplify, discuss, do something around that, right? Because India is burning tons of money on some backbone process which can be digitized. We have only done onboarding journeys largely for retail, but beyond that, have we seen anything, right? So I think we can digitize the banking side dramatically. So that's a good area to work on. Treasury and trade finance I spoke about. Now let's move to away from B2B. On the wealth side, new ideas are coming up. They are getting funded as well. I think a friend of mine is building FD marketplace, right, which to be used like in B2B. Upswing Anupam is launching. It's an interesting area, right? Nobody has done it. So Is it required? We'll see. Market will tell. But I think that is an idea which is tough to scale, tough to build on day one, but can actually keep you on the right track for a long time. On the wealth side generically and the insurance side, insurance में तो काम ही चालू नहीं हुआ. What has happened on
Yes.
insurance, right? Nothing. We have just not seen the starting point. I mean, they are as inefficient, and the metric insurance is so complicated still that I just couldn't figure out why my insurance companies moved the premium from 51,000 for 2 years to 1 lakh. And there's no logic to it, right? I mean, they don't know.
Yeah.
And we moved to a one fintech, and I just took their offer, right? So I think there's enough to be done.
Hmm.
On the content side, I also give you a belief. I have a very firm belief that with some time, with some education, embedded finance will improve. I think the fact of the matter is acquiring customers just for credit or just for payment is going to be hell of a lot expensive. So you need to work on the embedded side largely. If you are a fintech, you can aggregate B2B side as well,
Okay.
on the both sides, and also if you are running your own business, which is in third party areas, it can be e-commerce, it can be education, it can be accounting, in anything else. If you are aware of how to do it, and bring that from a tech DNA to a DNA of maybe a category which is close to NBFC or of that, you actually can build tons of money because the acquisition cost is zero,
Okay.
and you can convert with right insights. But it's not easy. I think we work with so many of them. And DNA change does take time, right? People say, मैंने कुछ चालू किया, immediately चालू हो जाना चाहिए, पैसा मिलना चाहिए. As if like झाड़ लगाया और आप उतार रहे हो. It doesn't work like that. It does take time. So I think all these areas are fundable. And what Oxyzo did on B2B side, lending side, I think more guys will do. And I see huge success there.
Mohit, right questions that you see, right companies that you see?
So I think naturally it's from a space perspective, lending is sort of evolving, and embedded finance is clearly one area which is sort of picking steam. Supply chain finance again is sort of picking sort of reasonable steam. On the consumer side, I think UPI is something which is picked up, and I think on the small ticket micro side, because it's a fine marriage between payments and small ticket lending. So, for example, if let's say 10 years ago, Bajaj used to say, I will give 10,000 rupees loan and still make money. Today, with UPI sort of discussions in foray, a lot of that can happen by a larger number of players, and hence embedded finance type of things will improve. So, I think lending clearly is one area. Some of the other places like pure payments, pure insurance companies, I think these areas are areas where 2 or 3 companies will, or 4 companies at max will be sort of size and magnitude. So I think unicorns or those sort of players are largely on those 2, 3 areas. But lending, I strongly believe lending and software as a service. I strongly believe that at least 40, 50, 60 companies and sort of their own relevant niches can survive and thrive.
Okay, so lending and software as a service SaaS companies. Samir said about mutual fund, personal finance, wealth tech related companies, and insurtech. Dhruv, what are the right companies that you see?
So it's basically the way I think people are now looking at it is that what is it that you have to offer, right? Is it purely a lending piece, or is it lending plus something? So if today, if the investor would look at it, what is the kind of wallet share are you getting in from a particular customer, right? If you're doing purely a lending piece, are you able to do some amount of a cross sell? Are you able to offer him an insurance product? Are you able to offer him a mutual fund product, a SIP product, something like that? That becomes somewhat interesting and important, because that ensures that not only are you able to get a larger share of the customer's wallet, but also you are profitable even on an overall basis, right? Because these are all plus income streams which are there. So to me, the way I look at it, if I'm looking at it from a financial wellness piece, it's got to be multiple of products which are offered and not just pure lending piece. That, according to me, will be one big differentiator. Secondly, obviously, its profitability is a key concern, because the days of purely cash burn is something which nobody just wants to look at it. They want to see a path to profitability. So that's something another, in my view, is critical. And when we say profitability, it basically encompasses everything. It talks about not only your acquisition cost, not only talks about your cost of funds, it not only talks about how you are managing your cost, whether it is your OPEX, whether it's a credit cost. It's basically overall, how is your yield protection done? So So all of these stuffs become critical for you to become a profitable entity, and these I think are the critical points which somebody would want to look at.
Sure. Abhinav, what are the right companies that you think will get funded or will lead the race?
Yeah, other than the sectors that Samir mentioned, and I would say wealth tech, completely agree. I just wanted to add a further nuance to it is alternate investment platforms. We're seeing a lot of those emerge, and maybe in future we'll see a lot of growth because as India becomes richer, a lot of alternate investment platforms for the large mass affluent becomes a very good play. Another thing that we are looking at is the EV financing space, because that's again one more area, especially on the commercial vehicle side. That's one more area of opportunity. And the right company is basically a combination of a good founding team with relevant experience and a business idea model which has a niche and ability to and scale. So have they found that area where they can differentiate, and then that should be large enough for it to be of large value.
Okay. Alok?
And Amol, just one point, there will still be companies required which will burn cash. And that those are still where, I mean, it's not that you have to have every business to have P&L, but the बहुत ही वाहियात बात है, right? We are simplifying everybody into same segment. Credit couldn't have been created without this framework. Slice could not have been created, nor Paytm. So when you are doing B2C and front ending thing, you need to burn capital any which way, right? Because you like it or not, without branding, nobody buys anything, right? So you need to entice. So it depends on the situation you are in. But if you today want to generalize only P&L matters, I think you should the investors, I don't know where it is looking. Many companies may not need funding, so they will say, I don't need any money anymore, and you just have a different situation, right? So I think there'll be contextual to a business you are in, rather than saying one blanket statement.
Okay. Alok?
Yeah, I'm also, I largely agree with the sectoral trends that people have pointed out. I do want to say that this is not a sectoral investment market. It is very much a micro, every company on its own merit. So sectors are providing more of a filter to investors of saying we understand these sectors versus we don't. But it's a very bottom-up picking market, largely because the FOMO is gone and there is time to do real diligence. From an investor standpoint, they're really asking the same question they always had in a 4-year time frame: how do I make money? Right? If it's a venture investor, they're saying maybe 6 years time frame: how do I make money? And I think in that context, leadership and innovation, leadership in terms of market share and innovation continue to be important parameters. Right? Investors are not going to make money by investing in one of the many, one of the dozen startups in a particular area who are all going to get 5% market share. So I think it's important to not lose sight of those aspirations while we talk about profitability and the likes. I think the profitability is really two questions. It's not one question. One is the viability of the model, which is a micro question, right? Of are customers willing to pay for what the company is producing, right? Are there enough of them? Do gross margins happen, right? But there is a second one, which is also anticipating the future needs of capital in a business and taking a view on whether the market will provide that capital or not.
Right.
A lot of the profitability conversation or the unit margin conversation is also being driven by just the view uncertainty in whether the next 2 years will be great for venture financing or not. Right. So it's not just a view on the company, but also a view on the private capital markets. So if the private capital markets were to start improving, then some of these concerns would be parked in favor of saying, are we truly building a company that can be a leader in the market? But I think some of the basic questions are remaining the same, and the profitability drivers, in my mind, still are subservient to the overall questions of innovation and the scope to be a leader in the market.
Sure. So I think there are a couple of questions which we already took into our conversation. So I still have 2 to 3 minutes left. I will take one question to all of you once again, and that's my last question. Maybe you can take 30, 40 seconds max. Is what next do you see in fintechs? Do you see consolidation will happen? Do you see the funding round will still go slow? Do you see that many fintechs will wrap up their shops and leave away? What do you think will happen maybe in next 2 to 3 years? And I will start with you, Abhinav.
No, 30-second answer. The fintech is an evergreen sector, and I see a lot of investment to come in this sector across various segments. It's a very broad sector as well, so I see no issues in terms of funding in the near future.
Okay, Dhruv.
Yeah, kind of agree with that. Basically, we have still scratched the surface. There is much more to do. So there is enough and more available for everybody in this space. There could be some consolidation possibly at a going forward time, but the depth of the market is yet to be still tested. So opportunity wise, there is immense landscape available for all of us, and I would also agree that innovation is the key. The more we innovate, the more product innovations we do, it kind of helps us in moving forward.
Hmm. Sure. Mohit.
Yeah, so I think India will sort of nominally double the GDP in let's say 7 years, and I think given the same similar level of population and the type of digital stack that we have, I think fintechs are not going anywhere. Rather, the market will sort of at least become 4 to 5 to 6 times. So I think it's like the sweetest spot for solving for small ticket products, which banks have traditionally done only with a regulatory beating. So I think
Hmm.
it's a beautiful time where you can do financial inclusion, you can do small ticket, be fashionable and be profitable. So I think it sort of continues to excite, and the money will sort of keep coming in. That said, there will be sort of some smaller companies who would have built good tech, but not strong go-to market or things like that. And there maybe we'll see some consolidation happening.
Okay, sure. Samir.
I think closures are happening as well. This is the reality. It's just that when you raise funds, you do tom tom, but when you close down, you just figure out where to merge or at least step away and find a job and then survive and live through that pain of going through it. I think so. The reality is that there are many closures, many sellouts. You would see a lot of acquisition opportunities happening right now. So I think it's a situation we are in right now. I think last 1 year nobody has reported, but I don't know how many companies would have closed. So I'm not talking about negative view ki bahut pad gaya hai, but I'm just giving a very honest view that this is happening on the ground. People are suffering as well as the models have crashed and there's no more funding for some time, and the capital is really difficult. So I think every combination is happening. But what I also believe is that uh, as the founders have gaining more ground and learning, the employee side in those companies is also getting groomed for, and they will take more risks as well, right? Because they've been groomed and worked with founders a lot. So I think when you think about 8 years of fintech or 9 years of fintech journeys, you also realize that the ecosystem and employees were also of that duration only, right? उसमें ही दो तीन चरण हुए हैं that these guys will evolve. So we should see more entrepreneurs coming up and with bit more innovation coming up. So I think everything will continue. But
Hmm.
I think I also have long firm belief that banks are going to be formidable right now because they have figured out what it is. And they figured out that it's not a nonsense, right? It is not a frivolous activity. You look at the decks for maybe Axis Bank, you'll be shocked at what they're doing. Now it may be slightly early and maybe slightly more showy, but it is what it is, right? If they what they're doing right now, they will have a bigger impact. They have balance sheet to work on. So I think we need to be conscious about that and also conscious about what new regulation will come and what new license. What if fintechs get banking license and it will come up 2 years, 3 years down the line? Many of the large fintechs or banking payment fintechs will actually get a banking license. And why not? India has not seen licenses for many, many years, right? I mean, last time we saw was, I think, 10, 11 years. So, I mean, time to get more licenses and get smaller banks to sort of get acquired, right? To give more leverage to the market.
Hmm. Right. Meaningful thoughts there. Alok.
Yeah, so Amol, I agree with Samir on the consolidation piece. I think there's a lot that is happening as we speak. We've ourselves been, looking at companies and just the flow of founders who are willing to have conversations is pretty compelling. Uh, I think in this balance between fin and tech, at least in the next year or two, it seems like the fin part is going to be, um, more emphasized than the tech part of it. And what I mean by that is that companies will have to demonstrate holistic financial services, understanding, strategy, execution. I do think that on the regulatory side, there is a trust deficit. And fintechs will have to work to build that. In my mind, that is a precursor to that sector being embraced into the incumbent industry, whether it is by regulators or it is by the incumbent banks. But I do think there is work to be done on that.
Hmm. Hmm. Sure. Quite meaningful one, I think. And I must say, I had a really diverse views, but the bottom line is the same. The green story is there from the fintechs, but spring will also be there, and the consolidation is happening. Future is bright. So amazing points from all of you. I must say, I must thank all of you for taking out time and sharing your views here on the ETBFSI platform. And thank you so much, ladies and gentlemen, for watching this show live and sharing your questions. Stay tuned with us. Bigger show very soon in Bangalore on what is next for fintechs. And next week we'll come with another set of speakers and we'll discuss what is next for fintechs. Till we get a great story about the funding, about the connection. So stay tuned to etbfsi.com and thank you once again, Samir, Mohit, Alok, Abhinav, and Dhruv for sharing remarkable insights here.
Thank you.
Thanks.
Thank you.
Thank you.
Thank you so much.
Thank you.
Thank you.